The fantasy of a no-lose trade vanishes the moment you understand this truth. Fear disappears not from certainty, but from alignment. The professional trader accepts risk, then structures it. Example: when price tests prior support on narrowing spread and declining volume, the trade is taken not with hope, but with predefined invalidation. 5 rules govern this mindset. Risk first, wait for confirmation, trade only strength, accept uncertainty, and let the market, not emotion, decide. The first and most fundamental discipline the trader must acquire is the habit of defining risk before the trade is entered. This point cannot be overstated, for until risk is clearly measured and consciously accepted, the operator is not trading, he is merely hoping. The untrained public approaches the market from the wrong end. They ask first, "How much can I make?" The professional, by contrast, asks only one question at the outset: where am I wrong? That question determines everything that follows. Until it is answered, no position should be taken, regardless of how attractive the apparent opportunity may appear. Every legitimate trade is built upon a premise, an assumption about the condition of supply and demand. If the trader believes accumulation is present, then that belief must be testable. There must exist a price level, or a zone, where renewed supply would prove that the premise is false. This point is not chosen arbitrarily. It is discovered through the study of price behavior, spread, and volume. When a market has tested an area and failed to attract selling pressure, the operator knows that only a decisive expansion of volume and spread through that level can negate the position. This is the true function of the protective stop. It is not a device for emotional comfort, nor is it a shield against loss. It is an instrument of logic. It marks the exact point at which the trader admits, without argument or hesitation, that his reading of the market was incorrect. Placing the stop where the premise fails, the trader aligns himself with the market rather than opposing it. Fear arises only when this work has not been done. The trader who enters a position without knowing where he is wrong will naturally experience anxiety, because the market now holds all authority. Each fluctuation becomes a threat. Every reaction feels personal. But when risk is defined in advance, the outcome of the trade no longer carries emotional weight. The market is free to do as it will, and the trader is prepared for either result. Consider, for example, a market that reacts back into a former support area on diminishing volume and narrowing spread. The professional recognizes this as a test. If supply is truly exhausted, price should not decline materially beyond this zone. The position is taken not because the trader is confident, but because the risk is small and precisely located. Should price suddenly expand downward with increased volume, the position is exited immediately, not in disappointment, but in obedience to fact. In this manner, losses are reduced to routine business expenses. They are neither feared nor avoided, only controlled. It is this control established before entry that gives the professional trader his calm. He does not trade to avoid loss. He trades with loss already accounted for. And it is only from this position of acceptance that consistent results may be achieved. The second essential discipline of sound trading is the abandonment of prediction in favor of confirmation. The public mind is forever engaged in guessing what the market should do next. The professional operator concerns himself only with what the market is actually doing. This distinction marks the dividing line between speculation and informed operation. Prediction is rooted in opinion. Confirmation is grounded in evidence. The trader who attempts to forecast future prices places himself in opposition to the market because he has committed to an idea before the market has revealed its intent. When price subsequently moves against him, as it inevitably will at times, he is forced either to defend his opinion or to suffer emotional distress. In either case, his judgment is impaired. The trained trader, on the other hand, waits. He studies the action of price in relation to volume and spread. knowing that. These elements disclose the balance or imbalance between supply and demand. He understands that large interests do not act impulsively. Their operations leave footprints, and those footprints appear as changes in effort and result. Only when these signs are present does the professional commit capital. Confirmation does not mean certainty. The market offers no such luxury. It means that the trader has observed sufficient evidence to justify action, with risk clearly defined should that evidence fail. For example, in a potential accumulation area, the professional does not buy simply because price is low or because it has declined for an extended period. He waits for signs that selling pressure is being absorbed, narrowing spreads diminish, volume on reactions, and an inability of price to make further progress downward. When strength finally appears, perhaps in the form of a rally with expanding spread and increased volume, the public often becomes enthusiastic. The professional remains cautious. He knows that a single advance proves nothing. What he seeks is confirmation through behavior, constructive reactions on reduced volume, higher lows, and a market that refuses to return to the lower levels. Only then does he conclude that demand is asserting control. This principle applies equally in declining markets. The amateur sells after prices have already fallen sharply, driven by fear and headlines. The professional waits for confirmation that supply is dominant, wide spreads, increasing volume on declines, and feeble rallies that fail on light demand. He sells weakness because the market has confirmed it, not because it feels dangerous to remain long. By waiting for confirmation, the trader removes himself from emotional urgency. He is no longer compelled to act simply because a market is moving. He acts because the market has invited him. This invitation is extended only when the evidence aligns with his analysis. Until then, inactivity is not indecision, it is discipline. Fear is born from anticipation. Confidence arises from observation. When a trade is entered on confirmed strength or confirmed weakness, the trader is no longer arguing with the market. He is responding to it. Losses may still occur, but they are accepted calmly, for the decision was based on fact rather than hope. Thus, confirmation replaces prediction, not to eliminate risk, but to place it under control. The trader who waits for the market to speak finds that he no longer needs to guess, and when guessing ends, emotional strain follows it out of the door. The third principle is one that the public persistently misunderstands, and for that reason it remains a continual source of loss and emotional strain. The professional trader aligns himself with strength, not with apparent bargains. He does not buy because prices seem cheap, nor does he sell because they appear high. He acts only when the market has demonstrated, through its own behavior, that demand or supply is in control. Weakness is seductive. A declining market offers lower prices with each passing day, inviting the inexperienced trader to believe he is gaining value. But value does not exist in price alone. A market that is falling is advertising one fact above all others: supply is dominant. To buy into that condition is to place oneself directly in opposition to the prevailing force. The market does not reward opposition, it rewards alignment. The professional understands that strong markets behave differently. Strength reveals itself not in excitement or headlines, but in resistance to decline, when reactions are shallow, when volume diminishes on pullbacks, and when price advances with ease and authority. Demand is asserting itself. These are not opinions, they are observable facts. The trader who learns to recognize them no longer needs to guess where a bottom may be. Consider a market emerging from a trading range. The public waits for a pullback to the lowest prices, hoping to buy cheaply. The professional waits for proof. When price pushes upward through resistance on expanding spread and increased volume, the character of the market has changed. Demand has overcome supply. The subsequent reaction, if it occurs on reduced volume and narrower spread, confirms that sellers are no longer aggressive. This is where strength is bought not at the lowest price, but at the right time. The same principle governs short selling. Weak markets are not identified by low prices, but by failed rallies. When price advances on light volume, struggles to maintain progress, and then declines with widening spread and increased effort, supply is in control. The professional sells into this weakness because the evidence supports it. He does not sell because he fears prices are too high, but because the market has demonstrated incapacity to rise. This discipline removes fear from the operation. When a trader buys weakness, every further decline becomes a threat to his confidence. When he sells strength prematurely, every rally becomes an accusation. But when he trades in harmony with demonstrated control, buying strength and selling weakness, price movement works with him rather than against him. It must be clearly understood that buying strength does not mean chasing price. It means waiting for confirmation that a move is legitimate and supported by effort. The trader enters on constructive reactions where risk is smaller, clearly defined, and where the prevailing force remains intact. If strength fails, the exit is immediate and unemotional. The market is never wrong. It is always in a position to prove the trader mistaken. By aligning with strength and avoiding weakness, the professional accepts this reality and adapts to it. He no longer argues with price. He listens. In this way, stress diminishes naturally. The trader is no longer trying to be clever or early. He is simply correct or quickly out. And it is this alignment with strength, rather than the pursuit of bargain, that marks the transition from speculation to professional operation. The fourth principle, though deceptively simple, is one of the most difficult for the trader to master. Patience is not a passive trait, it is an active trading skill. Most losses are not the result of poor analysis, but of premature action. The market punishes haste far more consistently than ignorance. The public feels an almost constant need to participate. They believe that opportunity is fleeting and that inaction is equivalent to failure. This belief is the root of many costly errors. The professional understands the opposite to be true. He knows that the market offers far more opportunities than he should ever take, and that restraint is as essential as judgment. Patience begins with preparation. Before the market opens, the trader has already identified the conditions under which he will act, and, just as importantly, the conditions under which he will do nothing. Without this prior framework, the trader becomes vulnerable to every fluctuation. Each movement appears significant, each rally or decline demands attention, and soon the trader is reacting rather than operating. Markets spend a great deal of time in states of uncertainty, balancing supply and demand, testing levels, misleading the public through false moves and erratic behavior. These periods are not designed for participation. They are designed to eliminate impatience. The professional recognizes these phases for what they are and steps aside. He waits not because he lacks confidence, but because the evidence is incomplete. Consider a trading range. To the impatient trader, this is intolerable. He buys support, sells resistance, reverses his position repeatedly, and accumulates commissions and frustration. The professional waits. He observes how price behaves at the boundaries, how volume responds to advances and reactions, and whether effort is producing result. Only when the market resolves itself through a decisive emergence of strength or weakness does he act. This waiting is not idle, it is attentive. The trader is studying character, noting changes in behavior and measuring the quality of moves. He understands that the market reveals its intentions gradually and that the earliest signs are often subtle. Patience allows these signs to develop fully before capital is committed. Impatience, by contrast, creates fear. When a trader enters too early, without confirmation, he places himself in a position of vulnerability. Every minor adverse movement now feels threatening because the market has not yet proven his position correct. He watches the screen compulsively, second-guesses his decision, and often exits at the worst possible moment just before the anticipated move begins. The patient trader avoids this condition entirely by waiting for alignment where structure, volume, and price behavior agree. He enters with the market already moving in his favor. The trade requires less emotional effort because it does not demand immediate validation. Time works for him, not against him. It must be understood that patience does not mean hesitation at the moment of action. When the market finally gives its signal, the professional acts decisively. His patience has prepared him for that moment. He does not delay entry out of fear, because fear has been eliminated through preparation and restraint. In this way, patience becomes a form of discipline that filters out inferior trades before they ever reach the execution stage. The trader who masters it finds that he trades less frequently but with greater clarity and consistency. And it is through this selective participation, not constant activity, that stress is reduced and results are improved. The market rewards those who can wait. It exhausts those who cannot. The fifth principle strikes at the very heart of emotional instability in trading. Losses must be understood as business expenses, never as personal failures. Until this distinction is clearly grasped, the trader will remain psychologically unfit for consistent operation in the market. The public trader interprets a loss as a judgment upon his intelligence, his method, or his worth. This is a grave error. The market is not a moral authority. It does not reward virtue nor punish ignorance in any personal sense. It merely reflects the ongoing contest between supply and demand. To personalize its verdict is to misunderstand its nature entirely. Every trade is, by necessity, a speculation. It is entered on evidence, not certainty. Even the most carefully analyzed position can fail, not because the analysis was careless, but because conditions changed, or because opposing forces temporarily gained control. The professional accepts this reality fully and without protest. He understands that loss is not the exception, it is the admission fee for participation. What distinguishes the trained operator is not the absence of losses, but the manner in which they are handled. When a trade is entered according to sound principles, with risk defined and confirmation present, a loss simply indicates that the premise did not hold, nothing more. The position is closed promptly, capital is preserved, and attention is redirected to the next opportunity. There is no need for regret, revenge, or justification. The amateur, by contrast, seeks to avoid losses at all costs. This fear leads him to hesitate when he should act, and to rationalize when he should exit. He widens stops, adds to losing positions, or avoids taking the loss altogether. In doing so, he transforms a manageable expense into a crippling liability. The loss becomes large not because it occurred, but because it was resisted. The professional does not resist. He budgets for losses just as a merchant budgets for rent or inventory spoilage. They are expected, measured, and controlled. This outlook produces a profound psychological shift. Once a loss is no longer viewed as a personal defeat, its emotional sting disappears. The trader is free to think clearly, to evaluate objectively, and to continue operating without hesitation. It must be emphasized that this attitude does not encourage carelessness. On the contrary, it demands strict adherence to rules. A loss taken according to plan is acceptable. A loss incurred through indiscipline is not. The former is a cost of doing business, the latter is an avoidable error. The professional judges himself not by outcomes, but by obedience to method. Over time, this perspective builds resilience. The trader no longer seeks validation from individual trades. His confidence rests in the consistency of his approach, not in the result of the last operation. A series of losses does not disturb him, provided they are small and controlled. Likewise, a series of profits does not intoxicate him, for he knows the market owes him nothing. When losses are accepted calmly, fear loses its power. The trader is no longer trading to protect his ego, but to execute a process. He can enter and exit without emotional friction. This neutrality is essential, for the market demands flexibility, not pride. In the final analysis, the trader who survives and prospers is not the one who avoids loss, but the one who understands it. By treating losses as business expenses rather than personal failures, he removes the greatest obstacle to sound judgment. And with judgment intact, consistency becomes not a hope, but a probability. The sixth and final principle brings all others into practical application. Emotion is not conquered by willpower, but by structure. The trader who believes he can simply control himself in the presence of risk misunderstands human nature. Emotion is a natural response to uncertainty. It cannot be eliminated, but it can be rendered irrelevant through proper organization of one's operation. The public trader enters the market with vague intentions. He has an idea, perhaps even a sound one, but no fixed plan for execution or exit. As soon as price begins to fluctuate, emotion asserts itself. Hope appears when price moves in his favor. Fear emerges when it does not. Because no structure exists, decisions are made in reaction to feeling rather than fact. The professional removes this vulnerability in advance. He operates within a framework that governs position size, entry conditions, and exit criteria. These elements are not adjusted impulsively. They are determined before the trade is placed, when the mind is calm and reasoning is clear. Once the position is entered, there is nothing left to decide. The market either confirms the premise or invalidates it. Structure begins with position sizing. The professional never risks an amount that would disturb his emotional balance. If the potential loss causes hesitation or anxiety, the position is too large. By reducing size, he restores objectivity. This simple adjustment allows him to execute his plan without emotional interference. Next comes the definition of the exit. The stop is placed at the point where the original reasoning fails, not where discomfort begins. This distinction is critical. When the exit is logically placed, its activation is not a surprise. It is an anticipated outcome. The trader does not feel rejected by the market. He feels informed. Equally important is the management of profitable position. Without structure, profits create their own emotional problem. Greed encourages premature exits, while hope persuades the trader to ignore signs of weakness. The professional avoids, both by adhering to predetermined rules, trailing stops, objective signs of distribution, or changes in character. Profit-taking is executed according to evidence, not impulse. This structure transforms the trader's role. He is no longer a participant pleading for favorable outcomes. He becomes an observer executing a process. The market supplies information. The trader responds according to rules. Emotion may still arise, but it has no authority. Decisions are already made. It must be understood that discipline is not enforced at the moment of stress. It is installed beforehand. The trader who waits until fear appears to summon discipline will fail repeatedly, but the trader who builds a system that requires no emotional judgment during execution finds that fear never gains a foothold. Over time, this approach produces consistency, not because the trader has become fearless, but because fear has been neutralized. Losses are handled efficiently, gains are protected intelligently, and capital is preserved. The trader's confidence grows not from bravado, but from repeated proof that his structure works. In the end, professionalism in trading is not a matter of temperament, it is a matter of organization. When rules replace impulse and structure replaces emotion, the market ceases to be a source of stress. It becomes what it has always been, a field of opportunity for those prepared to operate within it. In conclusion, the so-called no-lose mindset is not the illusion of avoiding losses, but the mastery of operating without fear. Fear disappears when risk is defined, confirmation replaces prediction, strength is respected, patience governs action, losses are accepted as expenses, and emotion is subdued through structure. These principles do not promise certainty, they promise control. The professional trader does not seek excitement, reassurance, or validation from the market. He seeks alignment. When preparation precedes action and discipline replaces impulse, trading becomes calm, deliberate, and sustainable. In this state, the market no longer dominates the trader's emotions. The trader is simply executing a well-reasoned campaign, one trade at a time.